Hello everyone, good morning, good afternoon, good evening, whoever you are, wherever you are. Thanks for watching my TikTok. Today I'm gonna talk about this fear of inflation, and let's figure out if there are chances of inflation or not. I say there is no chance of inflation at least for next 6 months. So let me prove it. Stay with me. Let me show you something, and I will prove it that there are no chances of inflation for next 6 months. So this is what Google says: two consecutive quarters of negative gross domestic products, which is GDP growth, indicates a recession. Okay. So we have seen that two negative GDP quarterly reading will indicate a recession. But the last quarter of 2024 GDP reading was 2.8 positive. Okay, this quarter of 2025, which is ending today, the GDP growth rate is expected at 1.8. Okay, no negative GDP. What does Google says? Two negative quarterly GDP readings usually indicate that economy is going in a recession. So we still have positive GDP. So for example, if by end of June we get one negative GDP rating, we won't be in a recession as per Google. By end of September, the third quarter GDP reading will come out. So if we get two negative GDP ratings by end of June or end of September, then we may go in a recession. Not right now, because GDP readings are in positive. Now let me show you some other macroeconomic indicators which indicate a recession. Let me prove it. So just search what causes inflation in Google. Okay, you will come up with these conditions which may cause an inflation in any economy. So they're saying increased demand. That's the first indicator. When demand for goods and services outstrips supply, businesses can raise prices without losing customer, leading to inflation. Right now, there's not such demand in the market. People don't have money to buy goods, okay? Because this tariff fear has evaporated money supply from the economy. So we don't have a lot of money available in the market. So suppliers cannot increase good prices, okay? Expansionary fiscal policy. What does that mean? This is the second condition. Government spending and tax cuts can boost demand, potentially leading to inflation if not matched by increased productions. Okay, government spendings are reducing right now. Doge is reducing government spendings. Okay, there are no tax cuts. Okay, they did not show any tax cuts, so we can say this condition is not meeting right now. And next is the third one is expansionary monetary policy. What does that mean? Lowering interest rates. Are interest rates at the low level right now or at the high level? They are sitting at 4.5, very high. Okay, so this condition is also not meeting. And increasing the money supply can stimulate borrowing and spendings, potentially fueling inflation. Is there a money supply in the market? Do you see quantitative easing announced by Federal Reserve? No. They have just paused quantitative tightening. So they are not printing money, no money supply in the market. Okay, this condition is also not meeting. Next, rising production cost. Increased cost for raw material, labor or energy can force businesses to raise prices. Yes, this condition is meeting due to tariffs. Material cost will go up. Okay, only one condition is meeting so far. Let's go to the second one. Third one, one, two, three, four, fifth one. So fifth one is saying increased wages. If wages rises faster than productivity, businesses may need to raise prices to cover higher labor cost. Wages are not rising right now, okay? Companies are not hiring new people. So there is a pause in the economy right now. So this condition is not meeting. Devaluation. A currency devaluation can make imported goods more expensive, contributing to inflation. Do you think dollar is devalued or highly overvalued? Dollar is not devalued right now. Dollar is sitting at 104 level. Dixie dollar index is sitting at 104. Dollar is not devalued right now. So this condition is also not meeting. Then they're saying rising international prices, increased prices of imported goods, of raw material. Yes, this may impact after tariffs. Uh, International suppliers may increase the product prices. Okay. Next factor is supply chain disruption. Okay. We have seen supply chain disruption during COVID when our imports got delayed. All the supplies of goods got delayed because of COVID. But right now we don't have this kind of situation. So this is also not applying right now. Okay. Next is government policies and regulations. Government policies such as environmental regulation or subsidies can impact production cost. Yes, this is valid again related to tariffs. After putting tariffs, the cost of goods may go up. Then inflationary expectations. If people and businesses expect inflation to rise, they may start raising prices and wages in anticipation. Right now, no company is increasing wages, and we have seen inflation numbers for last 3 months, and inflation numbers are coming below projections. So this is also not applied. Deficit financing. When government finance spending through borrowing, they may increase the money supply, potentially leading to inflation. So that's when they start printing money. Did they start printing money? No, they are not printing money. They are not increasing money supply in the market. So this condition is also not meeting. Housing market. The housing market can be major contributor to inflation, as rising home prices can impact household well-being and affordability. Right now, interest rates are sitting high, so no one is buying a house, no one is selling a house. Because sellers are also scared that if they sell their current house, which they got a mortgage on a very low level, like 2.5% or 3%, if they go buy a new house, they will be paying 7% interest rate. So no one is selling, no one is buying. Housing market is not overheated. Then exports can influence inflation due to supply pattern of domestic goods and services to household consumers. I don't think so exports are impacted right now. Right now, if you look at export and import, the balance, your physical balance, everything looks normal. So all indicators are, most of them, there are 14 indicators. Out of 14, only one is meeting the expectations of recession. That is tariff, okay? Other than that, none of these major indicators are meeting with the expectation. Like there's no money supply, Fed is not printing money, wages are not going up, prices are not going up that much as per the inflation numbers. There's no supply chain disruptions, okay? Dollar is not devalued, okay? And the first indicator which I showed you, just a minute guys. So first indicator which I showed you, you have to see two negative quarterly GDP readings, and then there are chances of recession. So whoever is telling you that there is a fear of recession, they just don't know what they're talking about. They don't have a basic knowledge of economics, okay? If you have a little bit knowledge of economics, you would know that there is no recession. Recession doesn't come when interest rates are sitting very high, when there is no money supply in the market, when dollar index is sitting up, dollar is not devalued, when Federal Reserve is not printing money, quantitative easing, there's no quantitative easing in the market, okay? So government spendings are coming down. So in these conditions, you don't see a recession. So rest assured, there won't be any recession for at least next 6 months, okay? I just wanted to prove this thing. I'm showing you on Google. You can go on Google and you can just search for these things which I showed you, okay? So take care.